Righto, is the mic too loud at the moment? No? Okay, cool. So let's kick off. No, it is too loud. Try that. The people that we're really going to be talking about today, although there are a couple of others who drift in, are Singer and Prebisch. And like most of the other economists that we've seen in the course of this, they weren't selected for their good looks. Singer was German but ended up being knighted by the British government. Prebisch sometimes gets described, in fact there was a book review that came out recently on his biography, described him as the Latin American Keynes, which might be pushing it a little hard, but he was an enormously influential man and ran the United Nations Economic Commission for Latin America for umpteen years. Okay, and the two of them in 1950 both published really influential pieces. The one truly influential piece was Prebisch's Economic Development of Latin America and Its Principal Problems. June 1950, out it comes. At the same time, Singer publishes a piece virtually the same month in the American Economic Review on the distribution of benefits from trade. And these are the numbers that really kicked off the issue. Prebisch took a long time series of the prices of primary commodities and the prices of manufactures, and he made a ratio, and he said, okay, starting off in the 1870s, if we take the ratio of primary products, that's basic foodstuffs, minerals, timber, that sort of thing, take a ratio of the average prices and put them to the average prices of manufactured goods, and look at what they call the simple barter terms of trade. If you were swapping primaries for manufactures, what would you get? We take the ratio in 1875 and call it 100. Well, he said it would have steadily gone down. Basically, if you were exporting primary commodities, the amount of manufacture that you would have got for each ton of the primaries you exported was steadily going to drop. Now, he was working with these simple barter terms of trade, but is that adequate? Is there a flaw? Are the stats realistic and reliable? People have been sort of going back and double testing Prebisch's basic finding for years. The most recent retest of the Prebisch hypothesis was one that put out by the IMF in 2013, and it actually supported Prebisch. It said not only there have been breaks in the series, it said, but there has been a steady downward trend in the simple barter terms of trade. The question is now, is this a problem? Is it a problem, and is this a justification for protectionist policies on the part of third world countries that are involved in this? Well, let's have a look. So, the basic hypothesis, okay, that less developed countries, which typically have a comparative advantage in primaries, are going to end up in trouble if they specialize in those primaries, as Ricardo suggests. So Ricardo and Smith are saying, go for your areas of comparative and absolute advantage and specialize in those, export those products and import the others. And the argument is, if you do this, you will suffer in the long run because the barter terms of trade are going to move against you. And there are implications from this. First of all, that the gains from trade are going to be distributed unequally. And secondly, a little more nuanced, there's an assumption that the distribution of income is going to, globally, is going to be worsened. Not just that rich countries are going to get richer faster than poor countries. Not saying that poor countries won't get richer, but that the gap between the rich and the poor is going to be increased. And in fact, that domestically within countries, the workers of the poor countries are going to be systematically left behind by the workers of the rich countries. Okay, and I have a little note to myself there. Comp Malthus. Why Comp Malthus? If you think about Malthus's basic hypothesis, that population was going to be growing faster than the means of support of those populations, it suggests that the price of food is going to be rising steadily, and yet productivity in manufacturing is going up. This suggests that the price of manufactures should be going down. So the natural tendency that we would expect in terms of classical economics, okay, in terms of the era of Smith, Malthus, and Ricardo, is the complete opposite of what Singer and Prebisch claimed to find. So it's the intuition of economics was being turned on its head. Okay, so let's zip on. What are the issues here? Well, there are a couple that we just need to sort out first. There's no doubt that Smith and Ricardo are absolutely bang on if we're looking at the gains from trade at any point in time. If you've got X and I've got Y, and you can produce X far better than I can produce it, and I can produce Y better than you can produce, sensibly, we should be swapping. We should be trading. As Lawrence, who's not here this evening, put it, there was a lovely little piece that popped out saying, Bill Gates should not be painting his own house. Okay, there are things that he can do much better. He should hire someone to do it for him. Now, that's a static gain at a point in time. But if you commit yourself to a product and hold on to it through hell and high water over time, might that count against you? Now, Prebisch and Singer were both looking particularly at the experience of Latin America. We need to go back to the turn of the 20th century. As the 20th century starts, two of the richest countries in the world in terms of GDP per capita are the United States and Argentina. Their income per capita is virtually the same. The United States proceeds to grow even further and ever faster. Argentina specializes in the production of beef and wheat. Mining becomes really big. British capital flies into Argentina, invests substantially, and it becomes a basket case. Now, some people would argue that Argentina became a basket case thanks to Juan Perón and not thanks to its policy of specialization. But Prebisch was saying, have a look at what happened. By committing to these primary exports, the second the Great Crash happened and the world entered a major recession, the demand for those primaries fell. The second the First World War broke out, and then subsequently the Second World War, and in both of them there were U-boats in the Atlantic, the market for Argentinian beef was in the UK, and that was the end. The result was that Argentina was left high and dry. It had committed to these things on the grounds that this was solid economic policy, and it was let down by them. there's a second question, and this was raised by Jacob Weiner. He said, the barter terms of trade are a nice story. But if you look at the barter terms of trade between someone who's exporting a primary cocoa, okay? A cocoa bean is a cocoa bean is a cocoa bean. A cocoa bean 100 years ago and a cocoa bean today are much of a muchness. The level of butter fat, of cocoa oil inside thing might have risen slightly. Maybe the productivity of the plants has been increased slightly, but actually not much has changed. You're a farmer. You're importing tractors. Compare a tractor today to a tractor 80 or 90 years ago. To simply talk about the number of tons of cocoa that you need to buy a tractor is missing a significant part of the issue. The tractor isn't the same. So that's the one aspect. A second aspect, the amount of labor that goes into producing a ton of cocoa probably hasn't changed too much. The amount of resources, the amount of factors of production that go into producing the tractor have changed enormously. So to talk about the barter terms of trade is actually missing the point. Of course, the terms of trade are moving against you. You're getting way more for your money in terms of other people's labor, other people's productivity, the productivity of the product itself for your ton of cocoa than the simple barter terms of trade would suggest. So perhaps that table that we saw of Raoul Prebisch's is only giving us an inkling of a problem and actually shoveling some major issues under the carpet. Okay, it could well be that once we correct for the factors of production that go into the thing, these terms of trade are not moving so badly at all. And Weiner came up with the notion of the single factual terms of trade, which is how many factors of production, how much land, labor, and capital goes into the tractor, and just leaving the cocoa on the side, or double factual, where you actually look at the amount of stuff that goes into both of them, and then say, okay, let's do the comparison and see whether things are still looking quite so bad. And then a variant on this, down at the bottom, I've talked about the homogeneity of primaries. Basically, the primaries are the same, but we see substantial technical change on the manufacturers. And in fact, we see new manufacturers coming in all the time. Okay, so assuming that in fact there is this substantive movement against the exports of primary commodities, of primary producers. What might cause it? Well, a couple of things have been posited, and many of these were posited by Singer and Prebisch. The first is income elasticity. One asks, as income goes up, people want to buy more, typically. Question, how much more? Now, if we're looking at foodstuffs, I eat bread, yes. If my income doubles, do I eat twice as much bread? Probably not. On the other hand, my wife looks at me. But the underlying reality is our demand for primaries probably doesn't rise that fast with our income. Now, globally, world income has been going up. But consumption of primaries per capita has not been going up that fast. On the other hand, as consumption of manufacturers, when consumption of manufacturers is looked at, we see that as income goes up, the demand for manufacturers rises very, very rapidly. Now, of course, are these universal truths? Have a look at oil. as world income goes up, what happens to the demand for oil? Your classic primary commodity. And then look at the primaries, which are luxury products. The De Beers Corporation has spent 100 years persuading the affluent of the world and the newly affluent of the world that what they need is diamonds. So talking about wheat will give you one story. Talking about primaries in general, minerals, agricultural products, and so on and so forth, not necessarily quite as clear. Another is the way in which prices are actually formed. Manufactured products are typically sold through what we call cost-plus pricing. The manufacturer says, what did it cost me to make it? What's my markup? That's the price. Commodities, oil, gold, iron and steel, anything that's traded on an exchange, the price is set by demand and supply. And therefore the price is necessarily volatile. The moment you're looking at demand, supply, expectations, and so on and so forth, prices go up and down like yo-yos. Speculators drive them up and down, all sorts of things happen. Whereas the cost of producing a product, the cost of making a stove, doesn't really change that much. The price of the iron and steel in it might change, but that's only a small component of the final value. Manufacturers tend to be very stable in price. Now, that's important for a third world country. It may not be, and we'll see this coming up later, the secular trend in the prices so much as the volatility of the prices that they get. Volatility is really difficult to deal with in business. Cost-plus pricing makes it easy. Okay, something else that might make a difference. Unionization. When Prebisch was writing, typically, workers in third world countries were not that heavily unionized. The unionized workers of the world were in first world countries. Result, as the first world exports its products and makes money, some of the benefit accrues to the workers of the first world. As the third world exports its primary commodities, they have labor reserve armies and so on and so forth. The workers do not get much out of it. Labor is kept at rock bottom prices, and the gap between the workers of the first world and the workers of the third world increases. This was one of the points that we raised earlier. That income distribution, not only between the countries, but between the workers in the countries, tends to open up. And the higher levels of unionization mean that the prices of the manufactured goods coming from the first world tend to rise with it. There are other aspects to this. If you look at industrial products, an example does it better. My pet one. When I was a student, I had a vac job working at African Lumber in Bulawayo, where they were spinning off veneer and making planks. And there were hundreds of workers. When logs had to be moved, they were rolled with crowbars, or somebody came along, if it was really a big lot, with one of the 2 or 3 forklifts that they had there. When stuff had to be taken off the back of a truck, it was taken off by hand. I went a little while ago to a lumber mill in Canada, and everything was automated. There were 5 or 6 people doing jobs that saw volumes of timber processed that made what was going on at African Lumber in Bulawayo look absolutely silly. Everything was automated. Why? Because Canadian labor is expensive. But if you want to set up a lumber mill today in the third world, where do you get the equipment from? You buy it in Sweden or North America or Germany or Canada. And what you're effectively buying is equipment which was made for countries where labor is expensive. So you end up with more and more really unskilled, unemployed labor in the third world, and an enhanced gap. Again, rates of population growth. Third world populations growing faster than first world populations result, again, the wage gap opens up, and the manufactures coming from the first world reflect the higher cost of labor in those countries. The effects of technical change. Again, benefiting the first world far more than the third. And so the upshot, over time, we see rising real wages in developed countries and relatively stable, low wages in less developed countries. Or that was Prebisch's hypothesis. Okay, so why might protection actually make a difference? Why would it make sense in terms of the Prebisch-Singer argument to respond to these issues by putting in place systems of tariff protection? Well, they came up with three basic arguments. We'll see a little more later as we go. The first, Prebisch called the rationing effect. He was writing at a time when US dollars were scarce. 1950, soon after the Second World War, foreign exchange was a scarce item in the third world. If foreign exchange is scarce and you have a foreign exchange constraint on growth, as South Africa had not that many years ago, what you want to do is to make sure that whatever foreign exchange you have is being used to best purpose. You can shape it, you can direct it to the areas you need by using a system of tariffs. The second he called the countervalence effect. And for those who are into it, I've got my little sort of demand and supply diagram over there on the side. I didn't label it, I'm bad. The story goes as follows. If one has a demand curve and a supply curve and an equilibrium point and a price, and one then imposes a tax, and a tariff is just that, it's a tax. The price goes up vertically, or the supply curve goes up vertically by the amount of the tax, but the actual price in the market doesn't go up by that much. What happens is that the supplier actually reduces the prices that he's charging in the market. So the consumer pays a bit more and the supplier accepts a bit less. So Prebisch's hypothesis will slap on some tariffs and the producers in the first world will charge us slightly lower prices. Is this realistic? Well, if you are a major buyer, yes, but how many third world countries are really making a substantial difference to the production of first world manufacturers? You know, the total amount being consumed by any individual third world country is likely to be tiny. Are first world manufacturers going to go dropping their prices just because Botswana or Zimbabwe or Mozambique decides to put a tariff on a product? No. And then there's what he called the allocative effect. And we can hark back to yesterday when we were talking about List. List mentioned intellectual and social capital. That's the allocative effect that Prebisch in particular was thinking about here. He didn't write it down formally. It was implicit in a lot of his writings. What he was suggesting was if you use tariffs to broaden the base of your economy, you'll actually change the way that people in the country work. If you can just try to use tariffs to kickstart things, there'll be training, and once there's training, there'll be a move towards entrepreneurship. Once there's a move towards entrepreneurship, there'll be greater vitality in the economy. You need to start things somehow. So you're not just trying to preserve an infant industry, you're trying to kickstart a habit, a thought pattern of growth and productivity, and so it was something much broader. It was about the social philosophy, if you like, of the entire economy. Okay, now comes the question. Were they asking the right question? Is the real issue a downward trend in the secular terms of trade? Or is it something very different? And here's a little piece that came from the IMF staff papers a few years back. It said, well, there's a typo there. Using a long data set, they analyzed the behavior of real commodity prices 1862 to 1999 and have two main findings. One, there has been a downward trend in real commodity prices of about 1% per year over the last 140 years. Fantastic. That is the Singer-Prebisch downward trend in the real barter terms of trade. And there's been evidence of a ratcheting up in the variability of price movements. That's the important bit. In other words, the volatility of commodity prices has been getting greater and greater and greater. Commodity prices were prone to ups and downs before. In the 20th century, as the century progressed, the amplitude of those ups and downs, the volatility of prices became greater and greater. And he says, the downward trend is of little practical policy relevance. It is small and completely dominated by the variability of prices. In other words, the Singer-Prebisch question may not have been the right one after all. What we need to do is to find a way of stabilizing commodity prices if we really want to look after third world countries. It's to get around the problem of price instability that third world countries really need to broaden their economies. And if you think about Zambia, which we were talking about yesterday, every time the copper price goes up, Zambia is happy. Every time the copper price goes down, they're in the doldrums. You really have to broaden the base of your economy to get around that problem. It's coming. But wait, that's not all. Okay, so export earnings instability, what are the issues? One, the commodity prices themselves are volatile. Two, if you've got a broad range of commodities, at least you have a chance. But if you have a narrow base of commodities, if you're Saudi Arabia, let's face it, you're stuck on oil. If you're Zambia, you're stuck on copper. The United States has any number of commodities that it produces. They don't have to worry. And then I've added one other that isn't in any of the sort of Singer-Prebisch style literature, but I think is becoming increasingly important. One of the sources of foreign exchange in the third world that is becoming increasingly important is tourism. And tourism is great if what you're doing is diversifying. But it is extremely dangerous as a hook to hang your hat on if it's the only hook you've got. Because any time someone decides to throw a hand grenade or hijack a plane or start a revolution in a country next door to you, doesn't have to be you yourself. All of a sudden, there are travel warnings coming from the United States and so on and so on, and you've got problems. If there's a drop in income in the first world, for some reason, as there was in 2008, 2009, what happens to tourism earnings all through the third world? They dive through the floor. It is something one has to be really realistic about. Okay, so we come to one of the other sort of major papers that has made a difference to the literature in recent years. Sachs and Warner, who wrote this piece called Natural Resource Abundance and Economic Growth in 1995, and it's spawned a huge literature. Basically, talking about this question, people have tended to phrase it in terms of the oil curse, but in fact it's increasingly described as a curse of natural resources. If you discover large amounts of some valuable natural commodity, is this a good thing or a bad thing? Most of us would argue you're much better off with it than you are without it. Without oil, Saudi Arabia would be sand and camels. With it, they have a reasonable quality of life. Yes, they have problems. The question is, why is it that we appear to have slower growth rates in countries that are resource abundant than countries that aren't? Have a look at Malaysia and Singapore. Singapore has nothing except a harbor. Malaysia has tin, Malaysia has rubber, Malaysia has all sorts of things. And it's diversified its economy. But they still can't keep up with Singapore. Why is it, in other words, that countries that are endowed with a wealth, a plethora of natural resources, tend to undercompete those that have got nothing? And there are plenty of examples. South Korea has very little, but it's been growing fabulously fast. Let it be said, largely because after 1952, the Americans couldn't afford to let it fail and pumped endless amounts of money into it until such time as it did take off. But it managed. Okay, what are the reasons? Well, one hypothesis is structuralist. Okay, that this long-term decline in the secular terms of trade is counting against them. Okay, but there are others. One is domestic rent seeking. If you have serious wealth in a country, if you've got mineral wealth, agricultural wealth, and so on and so forth, there's a serious incentive for people who have a little bit of power or access to someone who has it to try and grab a bit for themselves. And that leads to inefficiency. Okay, it gives rise to a political system which is not geared to high growth rates. It also tends to encourage dependency. It's easy to slack off. There's what people call the Dutch disease. For those who don't recognize the term, when oil and gas were discovered in the North Sea, the economy of Holland took a real beating. They had oil and gas, which was fabulous. But the Dutch economy was nice, broad-based, loads of manufacturing, loads of international tradables. And the second they got oil and gas, the Dutch guilder became a very, very strong currency. And as a result, imports became cheap, and their exports became unviable. And the Dutch economy really took a hammering. And we now name this after what happened to them. But in fact, it's a characteristic of many economies. If you have a commodity-based currency, and the commodity is doing well, your exchange rate goes up, and everybody else takes a beating. And then there's crowding out. If you look, and again, Zambia is a great example. Any Zambian who had brains ended up either in government or on the copper belt. That's where the money was. The copper belt drew in all the good artisans. The copper belt sucked up all the money. If you had funds available for investment, that was where they went. And the result is that the rest of the economy becomes depleted of resources, becomes depleted of skills, becomes depleted of investable resources. So these are all fairly reasonable and fairly common hypotheses. It's not to say that they are absolute truth. And there are ways around the issue. So what do we do about it? Well, first question. In response to all of these, is import substituting industrialization the answer? Ralph Prebisch himself was not a wild advocate of import substitution. He said, yes, you can use some very carefully targeted tariffs in order to benefit your economy. But don't simply go slapping up tariff walls on absolutely everything. And the reasons are fairly clear. One, tariffs that are put up as if they're going to be there in perpetuity just cause inefficiency. Secondly, in order to have import substitution, you need equipment, and equipment is almost invariably imported. If you have tariffs that allow some things through but not others, then you end up distorting your economy. And that's also a problem. And we have the evidence of South America and its economic underperformance for decades under import substituting systems. Okay, import substitution basically got a bad reputation. It tended to fail. And if you look at the success stories of the 1970s and 80s, they were the export-led growth economies of East Asia, and the failures were the import substituting economies of Latin America. When Chile turned it round, when the Chicago boys came in and said, free up the economy and open the gates, Chile took off, and the rest carried on down. Am I suggesting that the Chicago approach is right in all things? No, I'm not. But there's certainly something to be said for opening the doors, and certainly one has to be very careful if one goes for import substitution, not to have the kind of rent seeking that it can lead to, where people have a vested interest in keeping tariffs going far longer than they should, far longer than is warranted. Can it work? I have one example that is close to my heart. In 1965, when Smith declared UDI in what was then Rhodesia, its domestic economy was pathetic. They exported tobacco and gold and nickel and chrome, a whole raft of primaries. Their manufacturing sector was restricted pretty much to engineering works that were needed for all those industries. 1975, 10 years later, the Zimbabwean economy had diversified unbelievably. The manufacturing sector in Zimbabwe was booming. But already it was clear that that couldn't be sustained, because already it was clear that the equipment that they had was starting to wear out. Spare parts were becoming a problem. Making your own spare parts can be done, and it was done. But it's really expensive. You know, sometimes it's just easier to call its supplier overseas and say, do me a favor, send me a new one. And the sanctions regime allowed all the benefits of import substitution without the rent-seeking risk that you get when government is imposing tariffs. But even so, it didn't work 100%, and by 1980, when the sanctions period was ending, the economy was really battling. Okay, another thing that you could do, you could follow the lead of Norway. You could set up an oil fund. You could say, let's take the revenues from the boom times, because there are price cycles. When the product is booming, let's take the revenues. Let's take these extra revenues, the hoteling rents, and let's invest them. When the economy is in a downswing, we have something that we can use to support us if we have to. And they actually have two sets of funds set up. One is a stabilization fund and one is a long-term investment fund. But you can use that revenue for stabilization purposes, and ideally you can say, when the resource is exhausted, we will now have a source of income that the population can live on in perpetuity. So Norway has taken its oil revenues and it's invested them in securities, in equities and property. Not just domestically, but globally. And the idea is that only the revenues of that fund are actually being used for consumption purposes by Norway. So they don't just eat the profits as they come. The entire revenues are diverted in, and then the income of the fund is used to keep the Norwegian economy, and the income of that fund, of course, is relatively stable. That's one way. Does it always work? Well, if you want an instance, Angola has set one up. President Dos Santos' daughter is running it. His son was running it before. Am I totally persuaded that it's going to do what it's intended or stated to? I'm not persuaded. It might work. A third alternative, we can try and follow the Botswana approach. Now, Botswana has set up a fund in much the same way as Norway did. But they've gone a little further. They've insisted that De Beers should start doing some of their marketing and their stone cutting and so on and so forth in Botswana. In other words, they're saying, we're not just going to be the supplier of raw materials, we want some of the value chain to be here as well. Not because the value chain is where the money is, but for the reason that Prebisch actually gave and that List was talking about earlier, that if we can get people involved in the value chain, picking up skills doing this, well, when the diamonds run out, you'll have transferable skills. And it's the transferability of skills that's really important. That if you can just get Botswanans involved in the marketing of diamonds and the cutting of diamonds and so on and so forth, well, when the diamonds run out, they've learned something and it can be transferred into other activities. And the end. Right. Bang on time. Gentles, questions? Yeah.
Could you not argue it's to do with political maturity and stability? When you compared Malaysia to Singapore, if you compared Malaysia to Australia, which is a commodity, Australia has done quite well.
Yes.
I suppose Canada has that as well. And even I was thinking of the example of crowding out. My understanding of part of the problem that Greece has gone through is that everyone joined the public sector, but more doctors per head than anywhere else. So you can have that phenomena in a non-commodity.
Oh yes, absolutely. So crowding out is normally sort of put out as a consequence of government spending. But here we're seeing it as a consequence of having a vibrant mineral sector, let's say. It's sometimes given as one of the arguments for having an export tax. Economists typically dislike the idea of export taxes intensely, but it can be a reason. The issue of Canada and Australia, I'm going to ask you to hang on to it, because tomorrow I'm going to start off with a question, and it's something to ponder. If you look at the dominions, Australia, New Zealand, Canada, Australia, and South Africa, they were all started at roughly the same time. Australia and New Zealand a little later than the others. They were opened up by roughly the same people. They had roughly similar endowments. They were all natural resource rich. 4 of them took off and did remarkably well. 1 of them didn't. Why? What was wrong with South Africa that with exactly the same basic endowments as, I mean, let's face it, we're richer than Australia.
Cheap labor.
Cheap labor is expensive.
Okay, so we're going to be going there tomorrow. Other questions?
What is Singapore doing? That it's got no
Natural.
They've turned themselves into an entrepot center. So they're a trading center. They have a huge harbor. They have highly skilled and highly productive workers. The state approached the unions years ago and asked them to make a deal. Basically, they don't give trouble for X number of years, and the state will try and invite foreign investors to come and set up in Singapore. The union signed up, and it worked. It's an excessively law-abiding society where the rules are very strictly maintained. Everything is clean and neat and just perfect for investment, and it works. Would I like to live there? I had a friend who was a jazz pianist who was Singaporean, who couldn't abide the place because he said they don't understand jazz. Anything which is unusual, out of the way, not following the straight and narrow, is seriously frowned on. I mean, it's a heavily regimented society, but in terms of productivity, I mean, it's worked a dream. If all we look at is GDP per capita, they're one of the world's real success stories.
Going to decline. More financial.
Yeah. And China's competing with Alibaba. is always going to be difficult. But they are doing, I mean, they're doing amazing stuff.
If we hypothesize that we're moving into an era of protectionism for the next 4 or 5 years, what would it be? What would be the resultant probable outcomes for capital in terms of cost of primary oriented inflation and stuff?
Look, one of everyone's anxieties is that we are moving into an era of protection. The question is whether it can make a real difference. Everybody is hearing the protection coming from politicians. But so many people are signed up to trade agreements, not just the WTO. There are umpteen bilateral agreements as well. Reneging on one is actually a big deal. It's not something that you can do quickly and easily. And I'm not sure that you can always turn things around. We mentioned the other day, South Africa had a clothing industry. They lifted their tariffs and they allowed in cheap imports and they killed their clothing industry. But putting the tariffs back may not bring that clothing industry back to life. In the States, we're seeing Trump talking tariffs. It's not clear to me that he's in a position to actually impose them. People are responding and making nice noises, and Chrysler is saying, yes, absolutely. But so far, there's no evidence that he's physically able to do anything. He's got the next 4 or 5 years to try and get stuff done. He's got Congress and the Senate on his side. I'm not sure that the Republican Party is going to want to be seen as totally inward-looking, because the possibility of reciprocal impacts, if they start putting up trade barriers to Chinese products, the possibility of something reciprocal is quite profound. I think there's a lot more. What's my intuition? I'm no expert. There's a lot of inertia out there on the free trade side that's going to have to be overcome first. It took a lot to get rid of all the tariffs in the world, but the momentum is there. To turn it round, I think is not going to be simple or easy. What would it mean for South Africa, though? Actually, personal view is I think we might benefit, because much of our export is primaries. Our primary sector is not big in terms of GDP as a whole, but as a share of our exports, it's quite substantial. And those things that we export which are manufactures tend to have a high, sort of a heavy component of iron and steel and so on and so forth in them. So the mining equipment and so on and so forth that we export we're basically exporting large amounts of electricity and metals. Even South Africa is exporting aluminium. We don't even have bauxite here. We're exporting electricity.
All the energy is
Yeah.
smelted.
And these are things that won't be affected by international tariffs. On the other hand, a slowdown in manufacturers globally would either see those things coming to us more cheaply, possibly, or would actually benefit local producers. I live in hope.
A lot of the manufacturing economy, especially those who are resource poor, invest and secure resources in developing countries.
Yeah.
Why isn't developing countries
Going the other way? So, yeah, and the Chinese are buying land and mines and so on and so forth all over Africa, but I can't see Africa being allowed to buy factories in China. It's a great idea, but in fact, if you speak to anyone who's tried investing in the Chinese stock exchange at the simplest level, it's difficult. And if you look at a place like Korea, South Korea wasn't allowing foreigners to invest in South Korea until comparatively recently. It's not that simple. Not.
Cocoa bean. My understanding, it can only be grown in a sort of
Narrow belt, yeah.
Have they ever tried to form a cartel like cocoa?
Yes, they did. And the coffee producers didn't work.
Why didn't it work?
Stand for very long.
For the rent seekers.
Basically, they were trying. Everyone was trying to cheat. Yeah, that I can believe. And OPEC is much the same. They formed a cartel. People broke the rules.
Just more of a strategic orientation.
It's a mess.
Well, we'll try and give some real examples tomorrow, and we'll look at some of the other alternatives. Let's give it a bash. Gentle. See you on the morrow.
So, 19.